Welcome to the Risk Reversal Podcast. I'm Guy Adami, special guest, joined by my dear friend Danny Moses on this April 1st, the first day of the second quarter of 2025. Danny, how are you?
That was some first quarter, huh, Guy? A lot of fun.
It was, so let's talk about that. What stuck out to you? I'll give you a few things that sort of resonated with me. Volatility is back, and I will say this. Last summer, I think it was June or July of 2024, you appeared on CNBC's Fast Money along with Vinny and Porter, and you guys talked about making volatility great again. And it may have taken a month or so, but obviously we saw what happened on August 5th. And then for the remainder of the year, volatility was sort of percolating. And then obviously this year, it's become a bit of a story. We've been north of 20 for as long as I can remember. We just sort of traded down to 17 last week on that bit of a market rally, but vol is back. So that's the one thing that sort of sticks out to me.
I agree. And I think when we were together a month ago, we both talked about how this time is different in the sense of volatility is going to remain elevated. So plan accordingly. And so you basically gave back all the administration gains prior to the inauguration, right? We've already been through that. I think the hopes for deregulation are being offset somewhat by what regulatory changes are going to actually be occurring in the form of tariffs, et cetera. So I just think, Guy, with a market that was priced on 22, 23 times forward earnings, you were ripe for a sell-off. And I think that the one thing that stands out to me during the first quarter was a reset of how people view the U.S. stock market. What do I mean? It's always been a place that has great laws, great security laws. You feel like there's someone you can go to if something goes wrong, and all that stuff. And I just think now it's being treated differently or looked at differently, and that means a lower multiple. But at the same time, I think earnings estimates are going to come down. So that's a witch's brew, as you would say. And so I think we're just having a reset here until we get a clear path to what this policy is going to look like.
No, I agree with you. A bit of a reset for sure. And we had Vinny on the podcast a few weeks ago, and he talked about the irony of the policies of this administration. And again, this is not political in any way, but making Europe great again in terms of their stock market. And for the first time in a long time, the European markets across the board are getting off the mat. So to your point, people have found, I think, opportunity or investment ideas elsewhere, whereas historically, they'd probably just sort of stay here in the United States. So in some ways, we've opened the doors to other investments that people have sort of left on the side of the road for a long time.
Yeah, listen, we were overweighted the U.S. markets in general and just needed a small excuse to go find. Listen, nobody was looking at Europe. No one wanted to own China. And so it was kind of inevitable that it would end up there to a degree. It may be a little overdone at this point in terms of over allocation there, but it remains to be seen here.
All right. So tariffs obviously is top of mind. You can't turn on a cable news show these days without hearing tariffs at some point within a 2 or 3 minute span. I think we're going to learn a lot more tomorrow, apparently, in terms of what the plan is. There's probably still some formulation going on, but in terms of the impact on the market, I think this is just me. I think it obviously has impacted the market, but people are quick to sort of point out this was the cause. I think this was just sort of the final straw on a market that you were saying earlier was probably just expensive for a myriad of different reasons.
Yeah, somehow this tariff policy seems like the last scene in Spies Like Us when Fitzhugh is going into the closed door meeting and they're playing Trivial Pursuit to see who gets to run the world. I don't think there really is a plan. That's actually the good and the bad part of it. So meaning, I think it's ephemeral. I think things will change by the second, but still, it's just not fair to companies, public companies, private companies that need to make planning decisions for employment, et cetera, going forward. And I think the one thing that's also being overlooked, Guy, it's not just the tariff policy. I think it's just policy in general in the U.S. of America first. It's starting to hit the services business. So when you create a trade war with Canada, the knock-on effect of that is you're not going to get as many people traveling to the U.S. You're seeing now, we saw Peter Bookvar was pointing out that one of the largest hotel chains in the world on high end is seeing bookings leave the U.S. and go to Canada and South America. So the services business, the services industry has been the driver. Goods has been up and down, restocking, over-ordering, under-ordering, but services has been the mainstay ever since we came out of COVID. And I think that's being underappreciated in the market right now as well, Guy.
Well, when you have an economy that's basically built upon 70% built upon that, exactly what you're talking about, people spending money, the services business. I mean, I think that's problematic. And when you throw on top of that a consumer that, might be getting a little bit spooked here, and spooked in terms of what they see from the market on literally a day-to-day basis, both up and down. And again, I want to be clear. It's not to suggest that everybody here in the United States owns stocks. That's not my point. But I think one of the biggest barometers or benchmarks that people use about the health of the economy, for better or for worse, is how well or poorly the stock market's doing. And when these evening news shows lead with U.S. stock market down 2.5%, and that's across a swath of different channels, that has a way of spooking people if it lasts for a prolonged period of time. So I say this all the time, Danny. I never underestimate the U.S. consumers want to spend. They seemingly will do so in any circumstance unless they're scared. And I get the feeling that, people are starting to get a little scared out there. So you just said it, people not traveling here. There are a lot of knock-on effects. What are your thoughts on that?
Yeah, I think there's two parts to that. One is the wealth effect of the stock market itself that's been pervasive, across the entire culture of America over the last few years, ever since COVID. We talk about the gamification of the markets in general, but there's more people invested in the market than ever. But still, the top 10% are basically all of it. So that attitude or that nervousness around spending only has to change slightly to have an impact, right? Beyond that, again, to the normal consumer who maybe not invest in the stock market, making one less purchase or hesitating on one type of decision, that has massive implications. We're seeing it already show up in consumer confidence numbers of expectations, right? And also, Guy, expectations of inflation. And so the one thing that's here right now that we're not really talking about or as much as the Fed, which has really been a backstory, right, for the last several months. But when you think about it, the inflation stuff, it appears we're in a stagflationary environment, and that kind of ties the hands, at least the current Fed administration. We don't know how long he's going to last if things get a little out of hand. But that's also the backdrop, I think, that is making people nervous, is that we still have inflation. And so you would normally have built up ammo here, right, for the Fed to cut rates, potentially to spur growth, et cetera. I don't think that's here this time. And if they try to do that, I think that backfires.
So let's talk about that, because I agree with you 100%. First of all, you mentioned a couple things in there. Jerome Powell's term I think it goes through 2026. You can correct me if I'm wrong.
May of 26. So literally only a year.
May of 26. So he's got a year left-ish. A Fed official, and that includes the Fed chair, can only be fired for cause by the President of the United States. Now, cause is not, by the way, and I know you know this, but cause is not, I disagree with his or her policy on interest rates. Cause is for a myriad of things, and potentially illegal activity and those types of things. So it's fair to say that Jerome Powell's not going to probably do anything to create that situation. But there are a lot of people that believe that if he doesn't sort of acquiesce, he's going to find himself getting the axe. We'll see if that happens. By the way, if that does happen, I think it's very market negative. With all that said, you were one of the first people to talk about the possibility of stagflation. And I know I brought it up a number of times, and quite frankly, I was sort of laughed at. I think it was almost a year to the day that Jerome Powell said in response to a question, I see neither the stag nor the flation. And now here we are on April 1st, and you have more and more people talking about exactly that. I say that because the last piece of a stagflation puzzle is the job market. We're getting a jobs report this Friday. And I think it's always important, but more so now, given the fact that inflation is clearly still a problem, and there are obviously some growth concerns out there. So speak to what you view the importance. What should the market want? And that's really the most fascinating question on Friday.
I think the market wants job growth. I think right now, if you get a bad jobs number, you're going to start to increase the odds of a recession, which, by the way, for people out there, we might find out we were already in a recession in October, November. We look back, it might have happened in the first 2 quarters. So I don't go by someone defining when a recession actually occurs, which is 2 negative quarters of GDP growth, right? So put that to the side for a second. But I think people want to see a stronger footing, thinking that we can get through as an economy all the noise that's going on. So I would hope that it's okay, the number. And I think, Guy, more importantly, it's the wages that are within that also, because wage inflation. And listen, stagflation is occurring in the UK. It's a microcosm of policy, meeting growth, and you're seeing it firsthand. And then now their hands are a little bit tied, right, in terms of what they can do with rate cuts going forward. That's the scary part to me, like I just mentioned before. So I personally think we're obviously in a slowdown. I've talked about it before. I was on CNBC a couple of weeks ago, that the other stuff going on with Doge is having an impact on the economy. Again, private contractors, knock-on effect, making decisions. So now imagine being a company that's exposed to tariffs and government contracts, right? So this is kind of all getting blended in together, guy here. But the expectations right now is that we see rising chance of a recession. I think that's right. So I'm hoping for a decent job number. I think a bad job number and rising unemployment would cement the idea of a recession actually occurring.
Yeah, I mean, in this case, bad news might be bad news to your point, but I think you would agree that, that potentially is the final piece to this puzzle, because as we've talked about, once you hit escape velocity and sort of the jobs market, things move to that point rather quickly. And this is just my opinion, I don't think the market's prepared for that. And that sort of segues to this. JP Morgan strategist in mid-March showed that the S&P 500 was pricing in a 33% probability of a U.S. recession, which was up 17% from the end of November. Now, the flip side of that coin is the credit market is only pricing in 9 to 12% odds of a recession. So the credit markets, Danny, and you've talked about this as well, they seemingly remain I don't know, what's the word
Unscathed.
I'm looking for? Unfazed by all of this. But again, it's seemingly to me just another domino that's inevitably going to fall.
So there was a letter yesterday that Larry Fink put out. He puts out his annual letter for BlackRock. And this one was very self-serving, right? He talked about, instead of the traditional 60-40 stocks bonds split, hey, why not go 50-30-20 and make 20% private credit? Well, why would he do that? Because they've made billions of dollars of acquisitions within private credit, and now they need a place to stick it. So guess what, individual investor? You now get the wonderful opportunity to pay higher fees. Let me put this in context. BlackRock manages over $10 trillion, right? Is kind of what they have, what they custody. Within that, $600 billion alone is in the SPY, which everybody trades. Everybody knows it. They now have $600 billion in private credit, okay? The fees on $600 billion in private credit are $3 billion. The fees on $600 billion in the SPY is $180 million. So that was very self-serving. So BlackRock's quietly gained on KKR, Apollo, Blackstone, and figure these assets. They need a place to stick it. But to answer your question, because I did take issue with that letter because it was very self-serving. Answer your question is, banks had traditionally carried a lot of this credit, right? And now it's not. Now a lot of it's in the non-banking system, right? The non-bank system. So therefore, the mark-to-markets aren't occurring, in my opinion, as quickly. You're not seeing it. However, Guy, the underlying credit metrics are deteriorating. They're deteriorating in credit cards. They're deteriorating on subprime auto. They're deteriorating on auto in general. And that's always the first sign. And I'll tell people this again. Talk about this. You may cheer deregulation. Yay, goodbye, CFPB that was protecting consumers. It's going to make it that much worse. Late payment fees, interest rate, usury law issues, and all. So this whole thing is again, to use the term, a witch's brew. It's a perfect storm. And Guy, when credit does go, it's going to go really hard. To your point, it's not going to be, we're going to be elevator up and escalator down in terms of, I think.
Well, I agree with you. I'm glad you mentioned delinquencies and stuff, because I've been talking about it and people sort of look at me with their eyes glazed over, which is typically the case. But more and more people are starting to realize, oh, wait a second, serious delinquencies. And I think that's 90 days plus of non-payment. It's up to 11.5%. And it's the highest level we've seen, basically, I think, since or at least the last 14 years, probably since the great financial crisis. And that's happening, and you said it as well, in an environment where seemingly, at least statistically, we're not in a recession. Typically, those are types of levels you see during one. So the delinquency rates are on the rise without question. I mean, there are concerns on a number of different metrics on sort of delinquency rates and the amount of credit that's out there and some of the problems brewing below the surface. But to your point, if you don't have to mark anything, the market doesn't seem to notice until it does notice. So the one thing I will continue to look at, and I think the folks playing our home game should continue to have on their screens, and I don't think it's the best instrument out there, but the HYG. And again, I'm not suggesting people trade this. That's not my point. But if you look at this, Danny, this has quietly been rolling over since, I want to say, February, when it was trading a little bit north of 80. It's currently trading around 78 and change. Now you'd be like, okay, guy, it's a non-move. Yes, it's a non-move, but this is something that really doesn't move in the first place. And when you start to see signs of something, you have to take notice. So that's the one thing that I will continue to watch, because to your point, I think just because it's not manifesting itself in some of these instruments, and just because that JP Morgan report suggests credit obviously prices in a lot lower probability, it doesn't mean it's not happening.
And Guy,
so there's that.
One other thing worth noting is that the FHA, the Federal Housing Administration, which basically insures mortgages for lower income people, lower down payments, it's horrendous right now, the credit metrics. And that was the first kind of canary in the coal mine back in 2004, 2005. Now, I'm not saying we're going into a financial crisis by any means at all, but that's the stuff that you have to see. And that's irrefutable. And that's happening right now. So that is an indication that things are slowing in the economy, period. And so I know it's a small part of the housing market, but it's indicative of what's going on the lower end of the spectrum.
What do you make of the weakness, the continued weakness in semiconductors? Now, this is not a 1 week story. This is not a 1 month story. The semiconductors, depending on how you want to measure it, I'll pull out the SMH. Dan likes to look at the SOX, although they're very similar in terms of performance. The SMH is something that made its all-time high, I believe, in July of last year, somewhere north of $280. As we're sitting here now, we're trading about 210. We're at levels we last saw in September. It clearly has been underperforming. Obviously, the big components there are Nvidia, Qualcomm, Texas, Taiwan Semi, Texan to a certain extent. There's something going on here. And this was sort of the pillar of the bull case. Well, this pillar of the bull case, Danny, it's going on 9-10 months of underperformance.
So semiconductors have always been a prelude or an indicator of either slowing economy or growing economy. Memory chips, flash drives, things like that. To your point, the makeup of it changed with AI, right? And graphic chips and things like that. So we lost a little bit of the cyclicality as the secular trade kind of emerged. So now you have a sector that's been obviously pulling in, when I say sector, AI chips, let's just call it that. And you still have the traditional. So I think you really need to strip out kind of the non-AI chip companies from the chip companies, which I'm not going to do on the spot. It's probably indicating that things are actually slowing more than we even think because the AI stuff has inflated. That being said, now you're going to get the reverse, which is it might drop farther because of how far the AI chip companies have gone. So Nvidia, we've been saying, is the market to a degree. It has been the bellwether for the market, certainly a bellwether for semis. So it's hard to really look at that indice. But traditionally, Guy, semis have been kind of a leading indicator into where the economy is headed in general.
Little single stock story, or not so much a stock story, but just sort of what seemingly is going on in this sort of quid pro quo world that we live in. Mark Zuckerberg, who has seemingly been trying to curry favor with this current administration, is now seemingly calling in a favor. I guess if you look at this Wall Street Journal article, he's going to make an ask of the Trump administration in terms of some of the things that Facebook is facing in Europe. So what are your thoughts? I mean, look, I guess to a certain extent, this has always gone on, and maybe we're highlighting it now more because we live in an age of social media and we have access to everything. So maybe nothing has really changed. It's just changed in terms of the amount of attention it gets. But, what's your sense when you see this sort of, again, I'll use the term quid pro quo stuff going on between the private sector and obviously, the government?
Quid pro quo, Clarice. You can't do what you can't bring that phrase out without me doing a little Hannibal Lecter.
I know you're Hannibal, yes.
Okay. You got to do Hannibal Lecter on this. So, I mean, Zuckerberg can't have it both ways. Can't just change political parties, want it both ways. Europe has always been strict when it comes to tech and these antitrust issues and privacy violations. So they can try to use the tariffs as a negotiating tool, and Zuckerberg getting Trump's here and say, hey, while you're deciding on tariffs, use this as a piece maybe we can negotiate with. So I don't know. I hope they neuter him, to be honest with you. I hope they do what they need to do and don't give in to Zuckerberg, because the EU has always been in the forefront of these laws, and I think most of them have been correct in terms of protecting the privacy of their consumers, whether it's antitrust and price gouging, or whether it's data privacy. So I hope he loses, to be honest. And whatever quid pro quo he wants to use, that's his prerogative as the CEO of a company, of the company. So.
Well, yeah, he's not. Listen, I'll say this. I mean, for me at least, he's not the most likable person. So I'm sort of in your camp. But we'll see how that plays out. But these people have made their beds to a certain extent, and I think they're going to find themselves. They need to lay in them, as the saying goes. Here's an interesting one because there's a little bit of core weave in terms of market perception, what's going on. You obviously saw that CoreWeave IPO on Friday. We have said it a number of times. I didn't think it went particularly well. The CEO of CoreWeave at about 10 a.m. that morning on Friday, maybe it was a little later in the day, said that but for Nvidia, the deal wasn't probably going to close. Nvidia obviously came in as sort of an anchor buyer of the name at around that $40 level. But with all that said, SoftBank is going to do a lead on this OpenAI round. And, again, I don't know what to make of it. Nvidia and CoreWeave obviously are sort of attached at the hip to a certain extent. So I understand why Nvidia would step in, but the optics aren't particularly good. So there's a lot of interesting / odd things going on in these private public markets over the last few weeks.
Well, let's talk about SoftBank. Masa's son, obviously, it was just 2.5 years ago that he basically says, I'm out of investing. I mean, he got hit in WeWork, Wirecard, Greensill, et cetera. Now, give him credit for investing 20-something million dollars in Alibaba and turning it into 72 billion, right? The guy's a gambler. But here he is again ramping up. And I think one of the promises he made to the Trump administration was putting hundreds of billion dollars into the U.S. for investments, right? So he needs to stand behind that. This is interesting, right? Because he agreed a funding of up to 40 billion in this. And now it's kind of like 10, if then he's going to borrow the other 30. So he's not going to put himself out there as much. But listen, he needs to keep this going as well. Remember, he has a huge investment in ARM, right? That's, obviously that's a huge stock for him. That stock's gone from 180 to 105 over the kind of the last 9 months or so. So he's gotten hit there. So I don't know if this is Masa's son 2.0 destruction or not, but Guy, people need, like you just mentioned, Nvidia coming to save the day at CoreWeave, Magnetar telling those bankers, you get this CoreWeave public. We're going to be hung on this thing. We have a lot of other business lines with you and so forth. So a lot to this guy, to your point, and it's not a Ponzi scheme. That's the wrong word. But you want to but you want to keep the spending going, and you want to have capital available in the space. But it doesn't take a lot. If Nvidia's stock fails, not when I say fails, drops below 100, back to 90, back to 80, it is the godfather of all of this. And therefore, everything is based upon that. So all the valuations will come down accordingly, right? And then you're in a situation where the companies that need funding still from the markets in order to fulfill their business plan aren't going to get it. And so that's inevitably what we've seen in these kind of cycles. Not boom and bust is probably a little bit too dramatic, but I'll say it again. When secular goes back to cyclical, which it will at some point, when the tide goes out, right? Who's swimming naked in the water?
Yeah. Well, listen, I think the market has forgotten that these are highly cyclical industries that people seem to have things have changed magically into these secular, 5 to 10 year growth stories. And it just really doesn't work that way. It might appear that for a period of time, but it's just really not the way it is. And when, again, we've talked about this, you've talked about sort of the rules of investing, when you start to see a deceleration in margins, which you may have seen in the last quarter of Nvidia, although they've promised the reacceleration in the back half of the year, that remains to be seen. That's typically the time to sort of sell and say, I'll see you later, alligator. But we'll see how that plays out. I'm sort of with you. Now we're 25 minutes into this, and you notice I haven't mentioned one name, and obviously a name that's near and dear to your heart, that's Tesla, which continues to be on this roller coaster. I know you know the numbers, but maybe for some new folks listening, pre-election in October, this was a $220 stock that proceeded to go to $488. So basically more than doubled over the course of a month and a half, 2 months post-election, only to see the entire move given back into this recent sell-off we saw in early March. It just rallied up to about $285, pulled back a little bit. Here we are at $265, just to sort of set the scene. Wells Fargo just added Tesla to a tactical underweight list. They see no rebound after a rough first quarter, and they reiterated their $130 price target on the shares. Thoughts?
I'm surprised Wells Fargo hasn't had their banking license pulled yet. We're 2 hours in here in the morning when they've done that. No, but don't let the facts get in the way of a good story, right? So on fundamentals, we've always said it doesn't trade on fundamentals. It trades on hope. It trades on the future, AI, robo-taxis, et cetera, et cetera. But let's be clear. And I talked about this, I think, on Fast Money in early December. What he's done in DC is not, whatever he's Doge is doing and thinking that he's, helping the balance sheet of the U.S. government. He went in to protect himself. And there was multiple agencies that have been investigating him, including the SEC and the DOJ, and that's all gone. So to me, that's where that rally occurred, was on election day, was that, okay, there's no regulatory things that are going to happen, obviously, to him. I'm currently not involved in the name. I talked about that as well, but I'll say this. I said it's one thing to overpromise and underdeliver to Tesla shareholders. It's another to mess with the American citizens, was exactly what I said. And so the pushback, but it's an amazing guy, not just his shareholder base, but the people that buy his autos have gone completely 180. People that believed in a clean environment, that were left-leaning, loved him. Now they hate him. People that were like, oh, screw, there's no global warming. It's not that at all. This guy's just making money off U.S. subsidies. Hated him. Now they love him. It's really polarizing. And it's interesting to watch. But again, I think over time, all things being equal, if he wasn't involved in the White House and didn't have the connections that he did right now, the stock probably would be trading on fundamentals. But guy, we're already to the point that Wells Fargo made in their note. They're supposed to have a launch already of robo-taxi and things already occurring, I think, in June. That's not going to happen. So see what happens here, guy. But it remains the very polarizing story. And I'll say one other thing. I think we were a day away from a short ban on Tesla. You think I'm crazy? I lived through the short bans in 2011, right? The financial crisis. You got to just stop shorting the stock. So it was one phone call away, probably a $10 move away. If Tesla had breached 200 at some point, you would have probably seen it. And so to me, you can't really mess with it. You can follow it, but you can't really mess with it because it's not an auto company.
No, I think it's exactly right. I mean, you just sort of watch it with interest. I think there are levels where you can trade it, and we've pointed out some of those levels. I will say this, I think Howard Lutnick coming out on the heels of his prior firm, Cantor Fitzgerald, upgrading the stock a week and a half or 2 weeks ago. I think, to me, that's somewhat problematic, but, maybe I'm old-fashioned. With that said, what's cooking on the On the Tape podcast? You've had some amazing guests over the last month and a half.
Yeah, so later today, I'll be taping with Carter Worth, Porter Collins, and Vincent Daniel. Now, back in the day, Carter would come into our offices once a quarter, and we would present a list of names. We wouldn't tell him our position, long or short, and he would just give his unbiased view of what the chart was telling him. Some we would agree with, some we would push back on. And he was right more than he was wrong, but he always made you rethink your position of how technicals can play a role. So we have bourbon and charts coming tonight because it's after market hour. So we'll be drinking bourbon, doing charts, talking about various sectors, and that will come out tomorrow morning, Wednesday morning, in your feed.
I love that. Yeah. Courvoisier and charts or Chardonnay and chart, whatever it is, but bourbon has a better ring to it. Danny Moses, love seeing you. You always are a breath of fresh air, and you always have a different perspective that the audience loves. Dan and I will be on Market Call later today, Market Call tomorrow, Market Call on Thursday. I think we have Ben Callow of Baird Company.
Not Callow, Gallo. Judge Gallo.
What? And we have the TRB, the Reform Broker, also this week. So a lot's going on here at Risk Reversal Media. Danny Moses, you're the man, folks. We'll see you later.